Welcome to chapter 19, Charlie Munger's first rule, which we are going to be discussing vigilant leadership and understanding debt to equity ratio and the current ratio. In this chapter, we have 4 objectives. The first objective is to define vigilant leadership. The second objective is to understand the debt to equity ratio. The third objective is to understand the current ratio. And the fourth objective is to understand what levels of debts are acceptable. So let's get started. So as you learn in the very short lesson previous to this one, which is chapter 18, these are the 4 rules, and the one that we are going to focus on for this lesson is a stock must be managed by vigilant leaders. So what does that word vigilant mean? The word vigilant means to be carefully observant or attentive on the lookout for possible danger. So if you have a company that's managed by a person who is vigilant, that person is constantly looking for what could go wrong with the business, and that person is protecting the business from those potential dangers. So what are the potential dangers when you are managing or running a company? And as a owner of a company, which is you, which would be a stockholder, the thing you have got to really watch out for is debt. So that's what we are really going to be talking about in this lesson, as we talked about Charlie Munger's first rule. And we have 2 quick tools that we can use at our disposal for determining an acceptable level of debt for a company. The first tool that we can use is the debt to equity ratio, and the second tool we can use is the current ratio. Those are the 2 very important things that you have to understand whenever you invest. So if this is not something that you have ever done before, you definitely want to take notes during this lesson and learn both these ratio really well. So we will start off with the first ratio, which is the debt to equity ratio. And what we are going to do is I'm going to go on to Yahoo Finance website, and I'm going to pull up 2 companies to kind of give you a comparison of how these 2 companies look like at the debt to equity ratio. And I'm going to teach you how you can find the different terminologies of the balance sheet. So the 2 companies that we are going to use is Disney and Brookfield Corporation. So just a quick overview of what the debt to equity ratio is, and I'm going to put this in terms that are pretty easy for you to understand. If you were to add up all your debts right now, your credit card debt, your car loan, the loan on your home, all of those debts, every single one of them, you added them up. Let's just assume that it came to $20,000, because maybe you are not living at home, maybe you are renting, or whatever the case might be. But let's just say that all your debts come to $20,000. Then if you add up all of your equity, okay, and the easiest ways to determine your equity is to put it in this situation. Just assume that you died right now, you died today, and whenever you died, you are not married, you don't have any kids or anything like that. The money that would be left in your bank account, if a third person would come in and sell all the material things in your home, your computer, your clothes, everything, the value of that would all be added up, okay, and then you would pay off whatever debt you had. So let's say your car was worth $20,000 and you had $10,000 in debt on that car. So the net worth would be the $10,000, that would be the equity of the car. All that money that's left after you add up everything that you have, then you subtract out what you would have owed. Whatever left over is the equity, okay? And what you are doing is you are comparing the debt to the equity, and all you got to do is divide the debt by the equity. The equity that's left over, so in that scenario, let's just say that we had $20,000 of debt, and that the equity that would be left after you would have died would have been $100,000. Your debt to equity ratio would have been $20,000 divided by $100,000, which is 0.20. Okay. Charlie Munger likes to buy companies that have a debt to equity ratio that's less than 0.50. So essentially he wants to buy a company that has, for every dollar of equity, has only 50 cents of debt. So as that number becomes higher, let's say that the company would have $1 of debt and $1 of equity, that ratio would go up to 1.0, and that's a little higher than what Charlie Munger likes. He likes that debt to equity to be 0.50 or lower. If you don't really understand the term equity, I recommend that you go back to the day 3, what is balance sheet and margin of safety. And we discussed that a little bit more in depth and define that term maybe a little bit better than what I did here. So let's go ahead and go to our two companies that I said we would assess and look at the debt to equity, which was Brookfield Corporation and the Disney. Okay, so here I am at Yahoo Finance and I'm just using Yahoo Finance because I kind of know where all the terms are on this site, so I can navigate easily and bit faster for you. And what you are going to do is you are just going to come up all the way up here and see this area where you can input a stock code. So the first one we are going to look at is Brookfield Corporation. The ticker symbol for Brookfield Corporation is BN. So we'll go ahead and put that in and just hit enter. It brings you to all the information on the Brookfield Corporation company. Okay. So what we are trying to find is the debt to equity ratio, which can be calculated from balance sheet under financial statements. If you remember the rule that Charlie Munger likes to buy companies that are below 0.50 debt to equity, let's see what is the ratio for this company and how is that number being calculated. So as you look over here on the right of the screen, you can see that the balance sheet is under financials tab, which we learned about in the day 3, what is a balance sheet and the margin of safety lesson. And so we are going to click on the financials tab here and then balance sheet under it. Now, any time I look at the balance sheet, I always like to look at the most recent quarter. So in order to do that, you have two options up here. At the top, you can see you have an annual and then you have the quarterly. And I'm going to look at the quarterly because it has the most current information.